Olá, seja muito bem-vindo ao podcast FundsPeople. Hoje vamos falar sobre cover de bonds europeias e diretamente do Porto contamos com Francisco Falcão, fundador e CIO da Hawkclaw Capital Advisors e também um forte adepto do Fixed Income. O Francisco vai estar à conversa com Henrik Stille, o homem ao comando das soluções de cover de bonds na Nordea Asset Management. Esperemos que goste. Francisco, please go ahead.
Hi, Henrik. I would start probably. I think it is relevant to have a brief explanation about what is actually a covered bond. Maybe you would like to give a brief picture about that.
Yeah. No, but a covered bond is actually a very unique product because it's the only fixed income asset class that you can invest in where you have a dual claim as an investor. So you have a claim both against the bank that issued the bond, but also a claim against a pool of collateral. And that gives the investor a double protection that is very unique and has proven itself to protect the investors from any losses if we look back in history. There has actually never been a default of a covered bond anywhere in the world. So the covered bond investors, they always got their money back at maturity, and they also got their coupons at the time when they should receive them.
So you would say it is a conservative instrument that is used to balance risk on a portfolio. And saying this, what is the typical investor for covered bonds? Obviously, today an investor has access to the covered bonds, for example, through the suite of funds that you are actually in charge for Nordea. But how is it typically used in asset allocation?
Yeah, no, I mean, as an asset manager, we are of course using covered bonds actively in our portfolios, but asset managers are not the main investors in covered bonds, because the main investors in covered bonds, if you look at it on an aggregate basis, it's typically these types of investors that don't want to have any, they don't want to have much volatility on their investments, and they don't want to have any kind of default risk either. And that's, you can classify them into some different groups, but for example, pension funds are an important investor group in covered bonds. They like especially the long covered bonds that are 10-year or longer. Then we have bank treasuries that are also bank treasuries. They are actually the main investor group today in covered bonds. And that's because banks, they need to hold certain amounts of liquid assets due to new regulation that came over the last years. And these liquid assets, to qualify as liquid assets, it is almost only government bonds or covered bonds that you can hold as a bank treasury, because other credit bonds, they have just too large haircut and too large charge, so they are too expensive to hold. So for bank treasuries, if they want to have something in these liquid portfolios, it needs to be either government bonds, but then the covered bonds are usually better for them than government bonds, given that they trade with a pickup. And then, of course, we should not forget the ECB either, because the ECB is, of course, a large buyer of covered bonds as well. And the ECB, they buy covered bonds through their QE program. This they have been doing for a long time. And having ECB as a large investor in the asset class, you can have many, views about this, but when it comes to the safety of the asset class, I would still say that it's a positive feature, because an asset class where ECB is such a large investor as they are in covered bonds, it's not likely to be impacted by any defaults, or not likely to be impacted either by any on the regulation side. We are not likely to see any negative changes for covered bonds, given the large amounts of covered bonds that the ECB holds.
So, considering the current macro environment, what do you see as the main threat for threats and opportunities, obviously, for the covered bond market? For example, inflation, the ECB program to be reduced, as you just mentioned, that it is one of the main buyers of covered bonds. How do you see that impacting? This is one issue, and obviously the other one is in macroeconomic terms, as we have a dual recourse nature of the mechanics of the covered bond. You have credit risk on one side, and you also have obviously the cover pool on the other side, the quality of the cover pool, that dynamic. How do you see it evolving?
Yeah, no, but I mean, we've gone through a period now of very heavy stimulus from the central banks all over the world, and also from the ECB, and this has of course then helped yields to come down, and it has also compressed credit spreads across the different universes of credit bonds, including covered bonds. And then of course it's natural to think that if now the ECB they would remove some stimulus, then we will see gradually higher yields, and also that spreads will move wider again. But there, I think, I mean, you need to compare the different asset classes to each other, because still, I mean, in the end, we need to invest in something. And I mean, it might be that you will have some negative impact on the credit markets overall from the ECB's upcoming tapering. But when you compare the different asset classes, I think that covered bonds, they look very strong. And that's because covered bonds, in the covered bond market, if we look ahead the next 12 months, the expected supply is extremely low. We expect that the net supply for 2021 of covered bonds will be around -70, -80 billion euros. So a very strong negative net supply. It has actually never been that negative any year before. So there is really very, very small amount of issuance at the moment in the covered bond market. And that's because the banks, they are funding themselves directly through the ECB. And this direct funding with the ECB, the banks, they can continue to do this at least until September 22. So this will not change in the near future. And it also means that there is no incentive for the banks to start to issue a lot of covered bonds, at least not for the next 12 months. So supply will stay low, and this will continue to be very supportive for the covered bond markets. And if we compare that to government bonds, for example, because there you have a very different situation, because in the government bond markets, you have a lot of supply. First of all the countries in Europe on an individual level, they are running much larger deficits than what they used before due to the COVID crisis. So they have large deficits that they need to fund. And then in addition to this, there is also, on EU level, a lot of extra funding due to the COVID crisis. So you have a lot of supply of government bonds and government bond-related asset classes in Europe. And the ECB, they are of course buying these as well, just as they are buying covered bonds. But the difference is just that the ECB, due to the large amount of supply, the ECB, they are not buying as much covered bonds as they are buying covered bonds when you look at it in relation to issuance and in relation to outstanding amounts. So when the ECB, they starts to taper, this will have a much larger impact on the net supply of government bonds than on the net supply of covered bonds. We only need a little tapering from the ECB, and then the supply of government bonds will turn positive immediately. But even if the ECB, they would stop completely to buy covered bonds, we would still have a negative net supply of covered bonds. Mm-hmm. So the net supply position is much stronger for covered bonds than it is for government bonds, and that's why we think that covered bonds will be better, will have more support relative to the alternatives over the next 12 months. Okay.
Just one point there that I believe it could be relevant for who hears our podcast, which is, what's your view on inflation, and based on your view, how do you think it can impact the price dynamics of covered bonds? Because obviously in covered bonds, as you have also the cover pool, which majority of the times is linked to the real estate market, you can have there a double effect, and I believe it could be interesting to have that view, and how do you see things evolving?
Yeah, I mean, if we start with the real estate market, I mean, that's of course important, because 85% of all the collateral in covered bonds, it's mortgage loans, so it's the totally dominant collateral type that you can have in a covered bond. But I mean, we are not that concerned when it comes to the real estate market. First of all, I mean, everyone is always concerned about the real estate market. If it goes up, people worry about it, and if it goes down, people also worry about the real estate market. So it's always a source of concern, and we think it's better it goes up than it goes it goes down. And I mean, what you see right now is overall that real estate across Europe, they've had a very strong year. And it means that the LTVs in the cover pools, they are going down, because you have much more buffer on the collateral side to price decreases than what you had before. So the cover pools actually, they look much stronger today compared to how they looked 12 months ago. And that you can say actually for all countries in Europe. Then, of course, what's specific with this crisis is that there are some sectors of the real estate market where we had some negative impact. Because normally in a crisis, if you take the financial crisis or the sovereign debt crisis, then the impact on the real estate market is the same all over the different sectors. But this time there is a big difference, and that's because parts of the commercial real estate market is going through a structural change due to the COVID crisis. And this is something that we think will have a negative impact for many years ahead. And that's primarily three sectors of the commercial real estate market. So we have office space, shopping malls, and also hotels. I would say those are the three sectors where we actually have price declines over the last 12 months, between 10 and 15% if you look at it overall. And that's because the COVID crisis has changed the behavior of consumers. On the office side, I mean, people are working more from home, and to some degree, this will also continue going forward, putting pressure on office space. We are also shopping much more online, and this will continue to put pressure on shopping malls, for example. And then you have the tourism industry, and you can say that I mean, all of us really, I mean, we really want to go on vacation again. So I think the private tourism will probably recover quite fast, but the problem is the business traveling, and that will take much longer time to recover, if it ever will recover to the levels we had prior to the pandemic. And the hotel sector is very dependent on business travelers for their income and revenue. So those three sectors we are a bit concerned about, and that's also why we are not buying any cover bonds from those issuers that has large exposures to those three sectors. On the other side, you can say that the private residential real estate market is doing very well. And the part of the private residential market that is doing extremely well is actually the secondary home market, because that one is normally a part of the real estate sector that has problems when you run into a crisis. But not this time, because people are really looking for secondary homes due to this crisis. People want to have somewhere outside of the large cities to work, maybe to go on a short holiday. So the largest increases in prices of real estate across Europe, we are actually seeing in the suburbs and in more vacation-like areas. So it's not inside the large cities where you're seeing the strongest demand at the moment. So overall, the private real estate sector is doing very well, and that's also the large part of the collateral that we have in the covered bonds. So these parts of the commercial real estate sector where we have problems, they are actually, it's some specific issues that are involved there, but it's not an overall problem. And then when it comes to the inflation, inflation for the covered bond market, it will only be a problem if we get so much inflation. So the ECB, they need to be more aggressive in removing stimulus. And that, right now we cannot see that. We will probably get some high inflation numbers here in the autumn, but most things points towards that these will be transitory. You will have some temporary inflation due to the reopening of the economies in Europe now in the autumn and maybe in the beginning of next year. But when you look at how the inflation market are pricing inflation after that, then if we look, for example, at the end of 2022 or in the beginning of 2023, then the markets are pricing inflation back down again to 1.5%. And that's not an inflation that is very, very worrisome. And if it's only this temporary spike in inflation here in the autumn, this I think is something that the ECB will look through. And if that's the case, then I'm not that concerned about the spreads for the covered bond market, and not for any other credit markets either.
So you believe also that the reopening of the economies that are happening gradually in Europe will be supportive for the credit side, not only on the issuer credit side, but also for the pool of collateral. From what I understand, what you are more concerned, it's obviously commercial real estate, offices, and you see more opportunities on the residential side, correct? Do you have any specific region within Europe that you are more positive and others that you are a little bit more, let's say, I would say negative or neutral?
Yeah, actually, we are, especially relative to consensus, I think we are much more positive on Southern Europe because, and that's for many reasons, but you can say that due to less tourism, Southern Europe, they have been hurt more by the pandemic because a larger share of the GDP in Southern Europe comes from tourism. But it also means that now when the economies, they reopen, Southern Europe will also get a larger share of this extra consumption that we expect due to the reopening of the economies. And this together with the EU support packages, we're having actually quite a lot of transfer from Northern Europe to Southern Europe, we think will benefit the Southern European economies more. And then another thing is also that, when we look now around the world, it might be that, now we are it's going quite well in Europe with the vaccinations, and the economies, they are set to rebound, and we can resume traveling and so on. But that's definitely not the case on the global level. I think before we can travel to Brazil, travel to Asia, for example, I think it will not even happen during next year. And it means that all those people that normally goes on vacation to countries outside of Europe, they have to stay in Europe. And this, I think, it will increase the demand for vacations even more on Southern Europe. And this will benefit Southern Europe to a much larger degree than many are anticipated, I think. So I think Southern Europe will benefit much more from the reopening here of the economies.
Yeah. So you mentioned before that covered bonds, vis-a-vis government bonds, they have some advantages based on obviously the stock and let's say the supply side, and also in terms of the ECB program, the fact that they still continue to buy. So you have mentioned that obviously when they stop buying or gradually reduce the purchases, I would say, the government bonds will be more impacted than covered bonds in your view. How do you think that the ECB program will evolve going forward? What's the macro picture that you have today, obviously considering the current inputs?
Yeah, I think that, I mean, first of all, the ECB, they will probably stop the pandemic purchase program, the PEPP program, because it's called the pandemic program and it will be a bit difficult to continue next year with this program. So this pandemic purchase program, it will probably end in March 22 as the ECB, they have communicated. And also just when looking at this, it's interesting when you compare government bonds with covered bonds, because it's almost only government bonds that the ECB, they buy within the PEPP program. So if that's the first program that they will taper, then the impact just from what they are buying in this program is much larger on government bonds than on covered bonds. Then what the ECB probably will do is that they will transfer some of the capacity of this program, of the PEPP program, into the normal old QE program. So the normal QE program, there the ECB bought 20 billion a month prior to the pandemic. And when they close this pandemic purchase program, they will probably transfer capacity to the old QE program. So instead of buying 20 billion a month there, I think they will buy maybe 50, 60 billion a month. So also the normal QE program will be much larger after March next year than what it was prior to the pandemic. Okay. And the ECB will probably also transfer some of the flexibility in the pandemic purchase program to the old QE program. And that means, for example, that they can buy, they don't have to follow this capital key as strict as they did in the old QE program prior to the pandemic. So they will have some more flexibility. So this is the first thing that will happen. And then, I mean, I think just ECB, they will have to wait and see how the data looks next year. And then you could probably, see some gradual tapering of these 50, 60 billion. But I mean, in general, we are looking for a period where the ECB, ahead of us, where the ECB will continue to be a large buyer of bonds, because the recovery is not strong enough for the ECB to just leave the financial markets and stop buying. And I mean, they have said, the ECB have said also that before we get the first rate hike, then the net purchases need to be zero. So all the purchase program, they have to be at zero. And that feels like many, many years ahead. I think maybe 2025 or something, you could look for a rate hike.
That feels quite supportive for covered bonds, obviously. So thank you very much, Henrik, for this great explanation and all your views for the covered bond market. And thank you to Nordea. Thank you to FundsPeople. It was nice to have you in the call.
Thank you.
Thank you.
Thank you.
Thank you.